Hello, everyone. Welcome again to BFW 2401, week 5, bank capital planning, and this is part 2. Now, in part 2, we'll just continue what we have started in part 1, which is now we are trying to talk about the modeling, and we are trying to talk about the data analysis and achieving the target capital. So without further ado, let me just share my screen and show you so this is actually part 2. And we are talking about the second part of capital planning. And this is the blue font is actually what we are going to talk about, which is the two models. So first of all, we'll talk about, since we have decided the target capital, now we want to see what are the sources of the capital that we can get. And then we have to understand also the, talk about the external sources of capital, internal sources of capital, and talk also about the achievement of the capital target. Now, just to, this is maybe have, is known to you. So the way we get capital is we get it from internally sources, which is actually the return earning. And the return earning is that portion of the capital of the net income that is not distributed as dividends. And this is known. So the net income is two parts. Part is dividends, assuming we pay dividends, and the other part is the return earning. Now, that return earning is the one that will be accumulated to capital. And the external sources, if we need further capital to support our growth, then we have to issue a new share issue, or what you call it, externally generated capital. So this is the two terms, and actually one is related to the return earning, and the second one related to the issued shares. Now, there are some questions for the bank capital planners, and those questions are, what are the projected level of internally generated capital from the return earning, which means we have to know what is the actually expected capital growth. And number two, if we have set the target capital, the capital target, if the bank is now in target, how much asset growth, which means we are in target now, assuming our target is 7%. And the capital over the total asset is 7%. If the bank now is on target, how much asset growth can be supported by internally generated capital? Which means there is profit, and the capital is still and that's 7%, which is the target, but there has been an increase in the capital of 5%, which means I was 7% before. Now I am still 7% maintained later on, but the capital has increased by 5%. So actually, if the capital has increased by 5% from last year to this year, this allows me to increase the asset by 5%. Because now, if the target capital is 7%, which is the capital beginning of the year over the total assets, if the capital increased by 5%, you have a room to increase the asset by 5%, and you're still maintaining your capital target, which means this is a very passive thing to do to increase the asset. Just look how much the capital has been increased, and they increase the assets accordingly. So you keep that percentage of target capital constant all the time. So, but if we want a different asset growth rate, what should we do in order to stay at the target capital position? This is another question. And if we are not in target, what we should do? So that means if we have if we are going to increase our assets more than that 5%, if our planning to increase our asset by more than 5%, which means now we need more capital. So how can we keep with the target capital? How we can keep with that target capital in light of the growth on the assets? Now, if we are not on target, also what we should do. So is externally generated capital a solution in this case, or part of the answer? So this is the whole issue. Now, I was in a target capital, and if I'm in target capital, I will just be very passive. Whatever have been increased in my capital, I can increase my assets. And that is, a continuation of the growth of my assets. But if I have a plan to increase my assets more than what my capital allows, then in this case, actually, I need to look for sources for capital, which is externally generated capital is the solution. This is the whole story here. Now, internally generated capital, just to come to the basics, depends on two things. Depends on profitability and depends on the dividends, which means if I am high profit, if I'm very profitable, now in this case, the net income will be high, and then the more of that net income will go to the retained earnings. So high net income, high dividends, and high retained earnings, specifically assuming that I am maintaining the same level of dividends payout, the same distribution. And when we talk about profitability, the bank forms its strategies to maximize profit while maintaining risk in acceptable level. And this is why how the banks can increase their profit is just they can increase give more loans, do more investments, so they can generate more businesses and more profit and more interest income while maintaining the same level of risk or the accepted level of risk. Now, this includes planned asset growth and also predicted interest and other costs, how much I'm going to charge as interest and how much I am going to, and how my costs are, behaving. Now, changes would likely reduce shareholders' value if there is, if those changes on the predicted interest rates or on the profitability rate, if it doesn't go as, or if the risk is increasing. Now, those changes in any way, there is a possibility if they are not going according to supported strategies by the management, it could give a negative effect and decrease, reduce shareholders' value and reduce the share price. So this is actually very sensitive things to do. You can increase profit, but when you have to increase profit, you have to increase the asset, and increasing the asset, you have to maintain some type of accepted level of risk. Also, in the same times, you have to plan your interest if you are going to increase it, and you have to control your cost. Also, all of those changes, if not supported by proper strategies by the management, can actually give a negative effect and reduce the bank's value. Now, this could be very understandable, which is item number one. But item number two, which is the dividends, maybe this is one of the things that you want to look at in this class. So dividends policy is actually very, very important component and the internally generated capital, because if you pay less dividends, now you will have more retained earning and more capital growth, and therefore more asset growth. If you have high dividends, you will be left by less retained earning and less capital growth, and of course, less asset growth. Therefore, there has been some theories. This is the dividends issue is very important. The policies, because these policies of dividends, dividend is actually decided by the management and the board. I mean, shareholders has nothing to do about it. They just, accept what the board would say, if they're going to pay more dividends or less dividend. But taking any of those policies or assuming any of those policies by the management does not come without its cost. And it has to be planned carefully so it doesn't decrease the value of the shareholders. Now, retained earnings are the main internal source of capital. Dividends affect the availability of internal capital. So as I said, more dividends means less retained earning. So dividends also affect the cost of external capital. And this is a new issue. Please look at it, because this is also an investment. Because if you are not paying dividends, then that can affect the shareholder price. When it affects the cost of raise, and that affects actually the raising of more equity capital in the share market. In other words, whether you pay more dividends or less dividends, the dividend policy has to be carefully planned. In other words, as I told you, as I'm going to talk to explain to you, the theories, we have 4 theories, and not all of them noted in full agreement about the dividends policy. Some would prefer paying more dividends, some would prefer less dividends, some actually indifferent. So when the manager decided to take one of these positions, he has to understand what would be the effect on the share price. Because if you take the wrong action and the shareholders are not happy, then in this case, the share price will drop. And if the share price will drop because they will start selling their holdings in your company. And if this is happening, then in this case, your cost of equity, raising equity, will be higher because you are now selling your share price. When you issue a new stocks, they will be, maybe underpriced or in cheap price, which is actually affecting the level of capital that you are raising. Now, theories and dividend policy. We have 4 theories. One of them called the shareholder preferences. Now, shareholder preferences is actually this coming by just the abbreviation of it, M and M. Modigliani and Miller, this is 1960s researcher. Those people say there is no difference whether you pay dividends or you don't pay dividends, because the case from the perspective of the shareholders. We are talking about all those theories from the perspective of the shareholders, because they are the ones that can affect my share price if they decide to sell their holdings. Now, they say the argument is like this. If the shareholders did not get dividends, then their money will be actually accumulated in the retained earning. And the retained earning will increase the value of the company, of the bank or the company, and then the share price will increase. So it doesn't make difference whether you take it as dividends or you keep it inside the company. Your profit, you can get it as dividends or as a capital gain. So actually there is no difference according to the shareholder preferences. Now, and this is what these statements actually are saying. Now, but there is some assumptions for this theory, which is the first theory, which is shareholder preferences. One of them is there is no tax, which means there is no tax reasons, and there is no transaction cost. This is what we call transaction cost. When we say transaction cost, it actually comes down to the tax reasons and the personal money management reasons. Sometimes you need cash and liquidity for certain reasons. So let me talk about the tax. In the United States, for example, those elderly people and retired and the pension people, actually they use their money and invest in those companies. And the United States may be one of the countries, or maybe the only one country, who in constant basis pay dividends every 3 months. And look, it is like 3 months, it's like salaries. So in this case, dividends is very important in some other countries, and you have to look at the environment which you work in. Now, in the United States also, when you pay dividends, you pay tax on them. So the dividends you received, you have to actually file it in the tax return, and you have to pay your portion of that tax as an individual, as an investor. But if there is a capital gain, and you didn't receive, then in this case, in the US, you still have to pay for the capital gain. But come to Malaysia. Malaysia, if you have dividends, you will pay. It will be added to your income, personal income. If there is a capital gain, they will not count it. So, and this issue and the transaction cost, they assume the tax effect is not there. So the shareholder preferences is like indifferent. I'm not taxed whether I receive dividends, or I'm not taxed whether it is like a capital gain. And the other thing, there is no personal preferences or management reasons to receive dividends or not to receive dividends. It's has no effect on their preferences in this issue. But transaction cost will make it costly for them to convert their returns if they come into the wrong form. This is what we mean by transaction cost. If there is no transaction, for example, you need dividends and you received a capital gain. Now, you didn't need the capital gain. You need actually dividends as cash. So you will have to sell your holdings of shares to get, to liquidate some of them, which is actually not good. The other thing is maybe you just want capital gain. You are not interested in receiving dividends, but the company still pay dividends. So in this case, you will go and buy more shares. So this is what we mean by the transaction cost. Now, the transaction cost problem is eliminated in this assumption. The second theory is clientele theory. Now, the cash income is important to shareholders, as I told you. Now, in the clientele theory, they are receiving what we call 3 months. In the US, those pensions receiving every 3 months. It's like salaries. So if you don't give them dividends, they may just, it's a matter of necessity now. They will just go and sell their holdings and buy from another company who is paying, and every quarter on quarterly basis their dividends. So actually, here there is huge preferences of receiving dividends. So if you don't pay dividends, it will be a problem. So the manager now, when he decides how much dividends should I keep, how much retained earnings should I keep, and how much dividends I should pay from this net income, he has to look to this theory, the first theory, which is a shareholder, and the clientele theory. This is number 2. And he has also to look to another theory. We see the agency cost. Now, the agency cost is calling for more dividends. If people of the shareholders are working or perceive agency cost very highly, that means they are concerned about it, that they think that every single money and every resources stays in the company as retained earning will be spoiled or misused by the managers. So the solution is what? Pay me dividends as much as I can. So don't keep any more resources for the manager inside because they will misuse it. So the agency cost is a call for more dividends. The clientele theory is a call for more dividends or stable dividends. The shareholders, as I told you, is indifferent. So we are talking now about three theories. Let's talk about the fourth theory, which is actually very valid in this country, in Malaysia. And I have read a lot of reports for public bank, for CIMB, and they are talking about dividends. So this is coming through what we call signaling theory. And signaling theory is arguing that they signal, which means they send some information to the market to gain more confidence and trust among the public and the investors that they are strong. And how can they signal those messages? They can say, we are paying dividends and we are growing, which is in conflict, actually. It's either you grow and keep all the retained earning there and don't pay dividends, or you pay dividends and you just stop your growth because you don't have any internally generated capital. But some companies, not in Malaysia, and so many other places, the management want to tell that they are so well disciplined and so well, and they are managing the bank in a way that they are able actually to pay certain dividends in constant basis, and they are in the same time growing. And they will show you numbers, how much the payout for the, I think I read the report for public bank, how much the payout, they pay 2 times, how much the payout for the dividends, and how much was the growth of the bank. So that actually comes under something called signaling theory. And signaling theory actually looks, reflect strength and communicate with the shareholders and showing them and trying to bring more confidence to the market. So we are 4 theories. We are talking about 4 theories just to repeat them. Shareholders preferences, which say no difference between either you pay or not to pay, assuming that there is no transaction cost. And number 2, we are talking about clientele theory. Clientele theory is saying we need more dividends because we need it to survive, to live, to pay our dues as shareholders. And number 3 is actually agency theory, which is coming from the concerns of the shareholders that any money left or any resources left inside the company will be consumed and misused by the manager. So the solution is pay as much dividends as you can, get as much dividends as you can. And number 4 is the signaling theory, which is, it looks like it take it to the second level. And in this theory, management is trying to signal more confidence to the market by saying that they are so strong and growth and in paying dividends, and they can manage this conflict. Okay. Now, conclusion, when you come to the dividend strategy, this is like this. And this is actually coming from the signaling theory. You have to pay a constant level, which means if you decide to pay what we call it payout, the payout, if it is 30% of what, sometimes 50%, which means out of every single dollar you receive, you will pay, you make an income, you make it as net income. Out of each dollar in your net income, you will pay 50% of it. So you will bring the dividends payout and divide it by net after tax operating income. And this could be any percentage. So actually it could be maybe 50%. And this is what we call payout. It could be more or less of that. So as I said, it could be whatever, it could be 50% or 60%. But the point is this 50% or 60% is a policy. It's a policy for 2019, 20, 21. I mean, all the time, they say the payout of this bank is 50% or 60%. or whatever. Some companies pay around 70%, some companies and banks, okay? So the effect, it has to be stable. And this is what we mean by stable, which means the net income could decrease or increase, that's fine. But anyways, the percentage of dividends to the net income should be constant. This is what we mean by dividend ratio or payout ratio. You can look at it as dividend ratio, and some people call it payout ratio. Now, the effect, dividends will rise if operating profit will rise as market expected, but the ratio will be stable, which means the profit can increase, but the ratio will be stable. As I told you, this issue of dividends is a very, very sensitive to the shareholders, and it can affect the share price and the value of the bank. So in this case, managers, when they decide to do any policies in banks, they have to actually communicate clearly to the shareholders and tell them the reasons and the causes of this. For example, here in 1994, there is a report from the Westpac. Westpac is one of the biggest firms in Australia. And this is the manager actually, is saying in deciding, this is in their annual report, in deciding the most appropriate level of dividends, the directors were mindful of Westpac need to increase its level of retained earnings, the additional value that bank would be able to create as shareholders if it retained capital to generate additional profit. These people want to keep more retained earnings. They are not planning to pay dividends, and this is why they are actually, talking about the dividends policy will be affected actually by the level of growth they are planning to. So actually what they are assuming here, what they are implying here, they may not pay more dividends for the sake of increasing or generating more profit and growing. Now, which means they are going to give more loans. If you have more capital, now you are in a position to bring more liabilities, right? And when you have more liability, when you have a capital to support any growth, because the liabilities, you can get it anymore as long as you have capital, then in this case, you can do more, generate more assets and get more profit. But the point is, you have to keep enough, that target capital percentage, you have to keep it. Now, this consideration were balanced against the director's appreciation that many shareholders required their investment to produce dividends income. This is like a apology or something. The dividends was considered to achieve an appropriate balance between these competing reasons, competing reason of increasing shareholders' value. So, which means either we pay dividends or we can increase the value of the bank, and the shareholders are required to consider those decisions, which seems to be paying less dividends for the sake of increasing the assets and the income and the profit of the bank. Now, this is another report by NAB, National Australia Bank, and this is after 2009, when things were not really okay. So this is why I tell you they have to communicate. So the National Australian Bank has announced that cuts on its first half dividend of about 25% as it rides out to the global financial downturn. Now, the bank chief executive, Cameron Sellen, will says that dividends cut will help to boost its capital strength, which means they have problem with the capital. We intend to reduce our dividends to bolster our capital position as the investment weaken, he said. So this is actually a statement, and you can see a lot of statements from all those banks around the world when it comes to dividends. They have to communicate clearly to the stockholders. Now, we finished those theory things. Now we come to the data analysis. And we talk about the data analysis. We talk about two models. we talk about something called internal capital generation rate, or which we call it ICGR, or we call it the asset growth model, or the AGM. Now let's go to the those two actually models will help us understand how much we can grow. So this is actually the ICGR calculates the asset growth rate, which can be supported by a given amount of internally generated capital. Again, you have to understand the mechanism here. The mechanism here is not where to get the liabilities and pay the loans. This you can do all the time. The problem is, when you want to increase your assets, you have to keep a percentage all the time between the capital and the assets. Now, according to Basel, it's 10.5. Now, according to which we talked about it in part 1, which we call it the target capital, maybe it's 10.5, maybe it's 12, maybe 13. So I have to keep that 13% all the time. For any loan I will give, I have to finance or assume to finance 13% of it, which means the 87% of it, I can get it from the capital, from depositors and from debt, from whatever, that's fine. So to keep that, you need always, so the concern here is the capital actually, not the money that you can get it from the market. You can get 100% of the loan from liability. But the problem is you will be now, and you will violate your capital target and you will go to risk. This is if you don't go actually in a big problem with the regulators who want you to keep 10.5. So I want you to understand that mechanism. And this is why we want to understand how much those models can tell us. So look, this is the first model, which is called ICGR. So to calculate how much, this is the formula of it. And it will tell you how much capital will increase. Okay, if I know that capital, then I can go and increase my asset accordingly, assuming that I will raise the rest from the liabilities. So if I give you this information, now the target capital is 7%, and I want to keep that 7% all the time. Now the projected return on assets is 1.2, and the dividends payout is 45%, which means out of each dollar of income, 45% of it will go as dividends. Now, ICGR, if I calculate it, it will tell me that the capital will be increased by 9.43%, which means what? Which means now I am in liberty now to go and increase my asset by 9.43, which means I have a capital plus, now this capital is 1.943. Then this is the capital. I can increase it by that time. It increased by this one, which means this is the capital now. End of the year, then my assets could be the same thing, 943. This is how it works, which means I'm still holding the target capital, which is the 7%, which is the 7%. Which is the 7% now, I still maintain it. But my assets have been increased. My assets has been increased. So this is increased by how much? It was 1, now it was increased by 9.43, because the capital was increased by 9.3. So my capital target still the constant, which I had it before, assuming it was 7%. So the total asset could be expanded by 9.43 over the next year while maintaining the same capital ratio. So what if the bank distribute zero dividends. Well, okay, we will see. If I'm distributing zero dividends, I'll just maybe copy this one and make it here. So it will be like this. But this one now will be zero, right? Or maybe if it is zero, which means this is already one or doesn't exist. Anyway, if you calculate that one, it will be 1/7, 1/7 times, I think 17.14%, something like this. This is the increase in capital, which means you can increase now your assets by this amount. See, just because you decided not to pay capital, to pay dividends, the increase in capital has jumped from 9 to 17. This is why the issue of dividends is very, very important. Now, we come here, but will retained earning be sufficient to support bland asset growth? Sometimes I don't want to go passive like this model. ICGR is a very passive approach. We're telling you, don't do anything. By whatever your capital is increasing, just go and increase your asset accordingly. So you can keep the capital, the target capital constant. That's it. But here we say, no, we want to move one step more. I don't want, if I'm growing, I want to maybe capture more market growth. So if I'm here, if the market, if 9.43 is not enough for me, I want to increase my assets more than that. I want it to be, for example, 19%. So I need to grow by 19%, not by 9.43, which the internal generated capital allows me. I need to grow by 19. So in this case, to capture more market share, whatever. So the plan now of the growth is different, which means I have to go now to another model because I will have 10% more. So in this case, will retained earning be sufficient to support bland asset growth? The question is, depends of the bland asset growth is equal to what the internally generated capital, what the internal sources generates. That's fine. If not, then it's not enough. To analyze this, we can use the asset growth model. Now, the asset growth model has another formula. And so given a bank has a bland asset growth rate, say it's 20% or 30%, whatever, the asset growth model allows us to test whether retained earning will generate enough internal capital to support, which means it will show us the difference. To do this, we need to project the bank's capital position using asset growth model, which actually requires understanding the profitability or forecasting the profitability, dividends, and planned asset growth. This we need all of them to know. So this is actually will tell me how much is my profit, which is we measure it by the ROA, and the dividends, it's already the dividends payout, the D, and then the planned asset growth is actually what we call asset growth. This is what we have. So the formula now looks like this. So the asset growth model allows the bank to forecast projected position. The model starts by assuming that only source of additional capital is the internally generated capital from retained earning. So this is step, and the two steps process looks like this. So first step, use the asset growth model to project the bank's capital position. Second step, achieve the capital target. If the projected capital position is not equal to the target capital, then in this case, the bank needs to manage the level of capital by using external markets to raise more capital. Let's see, look at this. So this is actually the components and the items in this formula, but this is actually, so we have the capital ratio in time 0, which is capital in time 0 over asset in time 0. But we are looking for capital ratio in times 1, which is a capital ratio next period. And the way to do it is to get capital 1 in year 1 over asset in year 1. So what we do is we have to get the capital in beginning of the year plus the return earning and the asset plus the asset growth rate. And we will see, we will check now the, we will check the, what we call the CR1 end of the year. So look at this. This is actually the model. It's just the same thing. This is actually the capital beginning of the year, asset beginning of the year. And now this is the growth. This is the return earning. This is the growth in the assets times the ROA, which is actually this area from here to here, from here to here, this area is actually the return earning. This area is the return earning. Now, out of this return earning, you have to decrease what we call the dividends because we multiply by 1 minus D, okay? So, and this is the beginning. This is the beginning, and this is the return earning during the year, and minus the dividends. And this is the beginning of the year, the assets, and this is its growth. So in this case, everything is clear. I just want to know what is the ECR in this case. So I go and make calculations. I find it to be 969. Now 969, I already brought to the picture the asset growth, which is the 10%. So here we have 250 AGR, which is asset growth. This is how much I want to grow, 10%. And this is the asset beginning of the year. This is the ROE, and this is the dividends, and I get it 969. Now, the question is, so given that the data and relying on the internally generated capital, this bank would have a capital ratio of 969 in the next time period. So the second step is to analyze the position and decide if the bank is happy with the 969 comparing to its capital target, or a further reaction is required to achieve the capital target. Now, here it's not actually mentioned what is the capital target. We have to compare it to that. So, but some of the policies we can do is to check this one, to increase it or decrease it. To increase it or decrease this 969. We can do the following. We can change planned asset growth rate. So if we want to increase the capital, now we can increase the asset growth. If we want to decrease it, then we will have to decrease the asset growth. We can change the dividends payouts. So if we want to increase the capital ratio end of the year, we can either decrease the dividends or pay more dividends. But also all of this has, all of those policies and changes in policies can create some can reduce the shareholders' wealth value. And the third one is we can use external capital. This is in case external capital market to decrease or increase. Now somebody would say how to decrease. An increase, if I want to increase more capital and the capital ratio at year 1, which is the CR1, the 969 is not enough, I can go and buy more capital, right? But what if this is higher than what I'm looking for? Then in this case, I can go and reduce the capital through buyback, the buybacks, which means I go to the market and buy my shares and keep them inside the company as treasury stocks. Okay, this is an accounting. We can go and buy our shares from the market and reduce the capital, outstanding capital. This is if we have more, capital available. Okay, so let's talk now about something actually easy, which is the external sources of capital. So the external sources of capital, you can issue more ordinary shares or preference shares, or what we call this hybrid securities. Now, ordinary shares, we know them, maybe you know them from accounting. They are the best quality capital in the sense that this type of capital provides the largest reduction in capital risk per dollar raised. When we issue it, we can have a right issue, which means we can issue only to existing shareholders, so they are not impacted. And we have to decide on the allotment as a portion. So if I'm, for example, if I have 1 million share in the market now, and I decided to issue 100,000, then in this case, the percentage will be, I will increase, I will sell to every 10% increase for each holding, which means because I had 1 million, I increase it by 10%, I have to have, that proportion have to work. So I will increase around 10% for each, share outstanding. I cannot increase, but there 10% of a share, but assuming somebody has 100, I will give him 10. 1,000, I will give him 100. Of course, if they are planning to buy. We can do a new issue, which means go to the public and issue it. This is good because we will not bring new shareholders. And there is something called dilution will not be there. The same shareholders will stay with me. We just, So there is another thing called private placement, which means now I don't have to have a new issue or right issues. We just, settle it with some other buyers like underwriters or, those investment banks, whatever. Now, shareholders receive residual claim on income. This is just a description of the shareholders. They have voting rights and they receive the residual claim after we clear everyone. The second stage is the preference shares, and we have talked about it. They are, hybrid securities because they can serve as equities and also as debt. They have fixed dividends rates. They rank ahead of the ordinary shareholder. This is the whole thing, but they don't have any voting rights. And we have non-cumulative and cumulative. But non-cumulative is, you cannot redeem them in the future, which means if you don't pay today, you will not be paid in the future. This is what we mean by irredeemable. Other EBRA, or can you say Bank Nigara or any central bank, but they are talking about Australia. It must be major characteristics criteria of a capital, which I told you they can be changed to equity. Interest payments withheld if bank is difficulty, which means the interest payments can be withheld if the bank is in difficulty, which make it like it's a debt, but it can be like equity now. Essentially, these are debt issued by special purpose vehicles, and interest is paid, and they have no voting rights. So interest can be paid unless the bank decided not to pay them. But usually, they don't really represent unavoidable servicing charges like a normal bond. You can avoid it. If you cannot pay, you can avoid it, and it can be like a capital. Now, factors considered when choosing which type of capital. You have to look at the capital risk, because greater risk prediction per dollar of higher quality capital. It can reduce actually there will be high risk prediction per dollar when you use equities other than the other ones. Even when we talk about the regulatory regulations, like Basel III, whatever, they need equity capital has to be 7% at least. Now you have to look also at the cost. So higher quality capital is more expensive as the suppliers, provider of funds to the bank are taking more risk and higher issue costs. And also you have to consider the timing. If the timing is good and the share price is high, it's time to issue. If the time is not okay, if the share price is low or underpriced, you shouldn't actually issue in that time. And there is the issue of dilution. As I told you, dilution is you have voting rights will be diluted, which means if you issue the same, if you have 1 million share and you issue new issue of 1 million, so actually the voting right will be 50% of the old shareholders. Now the second thing, even the earning per share, while it was divided, the net income was divided over the outstanding shares of 1 million. Now you have to divide it by 2 million, which means it will drop. Now I'm talking about 1 million increase just to fix this example, but you can talk about 500 new issue or 100 new issue. In any ways, there is actually a dilution. And the dilution can be treated the reason, the way they explain how the dilution effect will go is that when we issue new shares, a new capital that will increase the capital for the bank and it will make more business and will increase eventually the earning per share. And so the earning per share will increase anyway. And maybe that if we are really equally profitable, any more capital will just increase the profit, which means the earning per share will not actually will not be impacted because we are not going to have the same income. We will have more income. So the earning per share maybe stay the same or increase. So this is what we call dilution effects. Issuing ordinary shares has a dilution effect on shareholders' voting rights, as I said. More shares, the voting power of each share is weaker. Dilution effect on earning per share, which is this issue. Now, more shares, income is divided among more shares. Now, but as I told you, it's not always true. But dilution effect is considered by the current holders of your equities. Now, issuing preference shares or hybrid has lower dilution effect than issuing ordinary shares because these people actually have fixed income. This is one thing. The other thing is they don't have dilution. They don't have voting right. So neither their dividends will be impacted nor the voting right because they are not actually voting. So definition, dilute is weaken or reduce the strength. Okay. Now we come to the achieving the target, the capital target. There is here a little bit calculations and maybe to explain to you. Last time we said whether the bank is happy or not happy, and they can decrease the capital or increase the capital if they want. Now we are talking about some type of example, which is achieving the target capital. Now you have to measure when you want to achieve the target capital, you have to measure the current bank capital position. You have to select a target, and target this should have been decided. Now you have to determine dividends policy and internally generated capital. You have to compare the planned asset growth and the internal resources of capital. You have to calculate the need for external capital and decide of which type of external capital. This is the whole planning process. So do you measure the current bank capital positions? Then you have to select a target of that capital. So maybe the position equals to the target or less than the target. Then you have to determine your dividends policy because it will impact the growth of your capital. And you have to compare also the planned asset growth, whether the internal generated capital is enough to support your asset growth. And then you will see whether it is enough or not enough. Based on that, you will calculate how much you need capital from outside or how much capital you want to get rid of. Now, to get rid of capital, it could be either by paying more dividends or by buying, your stocks from the market, which we call it buyback. Now, achieving the capital target, first step, use the asset growth model to project bank future capital position, and we already know this. Now, the second step is to analyze. You have three cases. Let's see. After you calculate the asset growth model, which is, for example, this 969, if you remember when we calculated. After you get this 969, there will be three cases in front of you. Now, those cases, either the 969, which is this C1, is in line with the target, which means it equals the target. 969 and my target is 9%, that's fine. So no further action is required in this stage. But if the 969 is above the target, which means my target was 7%, now I have 969, which means I have an extra capital. So you have to review the planned level of EGR, which means you have to increase it. You have to reassess dividends policy, which means you have to increase dividends. So when you increase the EGR, actually you will consume more capital. You will need more capital, so you will consume that that difference between the target, the old target, and what you have achieved. So you increased your EGR. You will reassess the dividends policy. Maybe you increase the dividends to decrease that capital. And number three, possibly conduct a share buyback. And this is how you decrease the capital. Now look at this example. In the case 3, if C1 below target, this is very clear. Now, if your target is 7% and you get 5%, so you have to review planned AGR, you have to reduce it, and you have to review other sources of internal capital. You have to reassess the dividends policy, which means you have to reduce the D. So more retained earning will be there. And you have to institute dividends reinvestment plan. Maybe don't pay dividends, but institute what we call a dividends reinvestment plan. And you can raise the last one, which is external capital. And this external capital can be from all those sources, and sources like equities or preference shares or common share preference shares or hybrid securities. This is how we calculate how much extra capital we should have. And let me give you this example. So you have to have the projected ratio, which is the one you calculated, like the 969, minus the target ratio. You have to multiply it by the assets and 1 plus AGR. This will give you how much external capital you need or how much external capital you want to get rid of. So the positive value, you have an excess capital and you need to retain capital to the shareholders like dividends or payback or buyback shares. And negative value, which is a shorter, and you need to raise capital from outside. Look at this one. So if here, look, the target capital is here, the target is 11%. And actually the projected, which I get, expected to get 969. And this is the asset times 0, and this is the growth. So when I calculate this one, I find that actually I have this amount of money, which is actually minus. I am in short of 36.25. Go and raise it from the capital. Now I can have also, so since it's a negative value, need to raise more capital from outside. As I told you, preference shares, common shares, or hybrid securities. Now this number can be plus. For example, if you calculate this and if this is for example 8%, and you calculate it again, you will get here a plus number. Now in this case, you have to pay more dividends, or you have to, it doesn't have to be 36,000. It could be any number, you know. It will be a plus here. I don't know what kind of plus. I don't know what the number, I didn't calculate it. But if this is 8%, probably this will be plus. And if this is plus, then these dollars, which I didn't calculate, need to actually pay them as more dividends. So you decrease that capital because this is an extra capital, or you have to buy back some of your shares, buy your shares from the market. That's all. So let me just stop sharing. Thank you very much. I hope, I don't know how long it took, how long time it, take this part, but hopefully it will be okay. Thank you very much and see you. Bye-bye. Good night.